Every day, millions of traders stare at charts looking for answers. They zoom in. They draw lines. They add indicators. They search for patterns. And yet, most of them still lose money. Why? It's not because they're lazy. It's not because they're unintelligent. And it's definitely not because they can't read charts. The truth is much more uncomfortable. Most traders misread charts because they're not actually seeing the market. They're seeing their emotions. And until you understand this, every chart you look at will continue to deceive you. Let's imagine two traders looking at the exact same chart, same market, same time frame, same candles. Trader A sees a breakout. Trader B sees a fakeout. Trader A buys. Trader B sells. How is that possible? How can two people look at the exact same information and come to completely opposite conclusions? The answer lies in psychology. Charts are not objective, at least not in the way most traders think. A chart is simply a visual representation of price movement. What gives it meaning is your interpretation. And that's where things start to go wrong. Human beings evolved to survive, not to trade. Thousands of years ago, our brains learned to identify threats quickly. This ability kept us alive, but in financial markets, the same survival mechanisms often work against us. When price moves against your position, your brain interprets it as danger. When price moves in your favor, your brain releases dopamine. You stop seeing information objectively. Instead, you begin looking for evidence that confirms what you already want to believe. This is known as confirmation bias, and it's one of the most expensive psychological mistakes in trading. Imagine you've just bought your USD. The trade starts moving slightly against you. Instead of objectively analyzing the situation, your brain begins searching for reasons why the trade is still valid. You notice a support level. You notice a bullish candle. You find a social media post supporting your opinion. Suddenly, every piece of information appears bullish, not because it actually is, but because your brain is filtering reality. You are no longer reading the chart. You are defending your decision. This is where many losing trades become catastrophic losses. Here's something surprising. Many traders believe experience automatically makes them better. Unfortunately, that's not always true. If you repeat bad habits for years, you're not gaining experience. You're reinforcing mistakes. A trader with 10 years of emotional trading can still make worse decisions than a disciplined trader with 1 year of experience. Because profitable trading isn't about seeing more patterns, it's about seeing reality more clearly, and reality is often uncomfortable. Most traders focus on predicting. Professionals focus on probabilities. This single difference changes everything. Retail traders ask, "Where is the market going?" Professional traders ask, "What is the most likely outcome? And what happens if I'm wrong?" The first question creates emotional attachment. The second creates risk management. One leads to stress. The other leads to consistency. When you become obsessed with prediction, charts become emotional. When you focus on probability, charts become information. One of the hardest lessons in trading is accepting that the market doesn't care about your analysis. It doesn't care how many hours you spent drawing trend lines. It doesn't care how confident you feel. And it certainly doesn't care how badly you want a trade to work. The market is not a personal attack. It's not trying to punish you. But many traders behave as if it is. Every loss feels personal. Every winning trade feels like proof of intelligence. This emotional relationship creates distorted chart reading. Losing traders often look at charts with one goal: to be right. That's it. They want validation. They want certainty. They want proof that their prediction is correct. This mindset creates tunnel vision. They ignore warning signs. They ignore risk. They ignore changing market conditions because their ego becomes attached to the trade. And once ego enters the equation, objectivity disappears. Winning traders approach charts differently. They don't ask, "Am I right?" They ask, "What am I missing?" This small change is incredibly powerful because it forces the brain to search for opposing information. It reduces confirmation bias. It increases objectivity, and it improves decision-making. The best traders are not the most confident. They're often the most skeptical. Today's traders face another challenge: information overload. Every day, thousands of trading opinions flood social media. Bullish predictions, bearish predictions, market forecasts, expert analysis. The problem isn't the information itself. The problem is that traders use it to reinforce existing beliefs. They don't search for truth. They search for agreement. And every time they do, they become worse at reading charts independently. If you want to improve your chart reading skills, start with these 3 principles. First, separate analysis from emotion. Before entering any trade, ask yourself, what evidence would prove me wrong? Second, focus on probabilities, not predictions. No chart guarantees an outcome. Every setup is simply a probability. Third, accept uncertainty. The market is uncertain by nature. Your job isn't to eliminate uncertainty. Your job is to manage it. The reason most traders misread charts has nothing to do with intelligence. It has nothing to do with indicators. And it has nothing to do with secret strategies. The real problem is psychological. Most traders don't see what is actually happening. They see what they want to happen. And until that changes, no indicator, no strategy, and no course will save them. Because profitable trading starts with understanding the market, but consistent profitability starts with understanding yourself. If you can master your emotions, your charts become clearer. If your charts become clearer, your decisions improve. And when your decisions improve, everything else begins to change.